All right, today we are pulling back the curtain on the fundamental craft of auditing. We're going to get right into the nitty-gritty of how auditors actually do their jobs by breaking down the single most important tool they have, the audit procedure. Let's get into it.
You know, it all really starts with a pretty simple question, but one that has huge implications. When you look at a company's balance sheet and it says they have, say, $1 billion in assets, how do you really know that's true? How can an auditor be sure that those factories, those trucks, those computers actually exist and belong to the company? That's the puzzle we're going to solve today.
And to solve that puzzle, you first have to understand what an auditor's mission truly is. I want you to think of them as financial detectives. See, their job isn't to just blindly accept the numbers they're given. No, their job is to challenge them, to test the claims, or what we call assertions, that are hiding behind every single number on those financial statements.
That's it, exactly. Every number is a claim made by the company's management. It's them saying, we assert that this asset exists, or we assert that this revenue really happened. The entire purpose of an audit is to gather enough good, solid evidence, what we call sufficient and appropriate evidence, to prove whether those claims hold up.
So how do they do that? How do they build a test to get that evidence? Well, this brings us right to the heart of our explainer today, the anatomy of an audit procedure. This is the blueprint, the literal instruction manual that auditors use to systematically gather proof. If you get this, you really get the foundation of all auditing.
At its core, an audit procedure is just a set of instructions. But the most important word on this slide is clear. We're not talking about a vague idea like, hey, go check the assets. An audit procedure has to be a specific, repeatable, and totally unambiguous instruction that anyone on the audit team can pick up, follow perfectly, and get the exact evidence needed. And here it is. This is the secret formula. Every single well-written audit procedure has these three parts. First, you have the action. That's the verb. What are you actually doing? Inspecting? Recalculating? Second, you have the source. That's the noun. What are you looking at? An invoice? A bank statement? And third, you have the objective. That's the why. What claim are you trying to prove? Existence? Completeness? Remember this. Action, source, objective. That is the magic recipe.
And this slide just shows you how powerful that formula is. Look at the difference. On the left, check a sample of assets. I mean, what does that even mean? What does check involve? Where do I get the sample from? What am I trying to prove? It's totally useless. Now look at the right. Action. Select a sample and physically inspect them. Source. From the non-current asset register. Objective. To verify existence. See? It's a perfect, foolproof instruction.
And this right here, this is the gold standard. A perfectly designed procedure is so crystal clear that a brand new junior auditor, someone who has never even seen this client before, could read that sentence and know exactly what to do. That's when you know you've written it correctly.
Okay, let's take this blueprint out of the textbook and into the real world. We're going to see how this works in one of the most classic audit situations you can imagine, verifying a company's inventory in a warehouse.
So picture the challenge. A company is telling you they have millions of dollars of stuff sitting in a warehouse. As an auditor, you need proof. You have to get evidence that all those boxes are actually there, that they contain what the company says they contain, and that they're in good condition. And usually, this means you got to go attend the year-end inventory count.
Now, here's a really crucial point, and it's a super common misconception. The auditor's job is not to count clients' inventory for them. Can you imagine? It would take forever. Instead, their job is to audit the client's process of counting. So, as you can see, they watch what's going on, they check the instructions, they inspect some items for damage, and, this is key, they perform their own test counts. That's where they just grab a random sample that the client has already counted and they recount it themselves to make sure the client's process is working right.
And what the auditor is really looking for are signs of a well-controlled process from the client. Things like, are the people counting it independent, like staff who don't normally work in the warehouse? Have they stopped all inventory from moving around during the count so nothing gets missed or double counted? Do they have a good system for flagging damaged items? The stronger the client's controls, the more the auditor can rely on their count, and the stronger the audit evidence becomes.
Okay, so now that we've seen a procedure in the wild, let's level up. We're going to look at a more advanced, really clever technique that shows you how professional auditors think strategically to save a ton of time. It's called directional testing. This concept is seriously smart. Because of the way double-entry bookkeeping works, where every debit has a credit, auditors can design one test that actually checks for two different things at once.
Instead of just testing randomly, they pick a specific direction to test in, which allows them to focus on a specific risk, either the risk that the numbers are too high, which is overstatement, or the risk that something's missing, which is understatement.
So let's break this down. First, let's test for understatement, the risk that something is missing from the financial records. To do this, you have to start outside the accounting system. Look at the arrow on this slide. You start with the source documents, the real-world proof, like a stack of delivery notes. You pick a sample from there, and you trace it forward into the accounting system to make sure it was actually recorded. You're asking, did everything that happened in the real world make it into the books? This is a test for completeness.
Now, we flip that whole process completely on its head to test for overstatement, the risk that there are fake transactions in the books. This time, you start inside the accounting system. You pick your sample from the sales already recorded in the ledger, and you vouch them backwards against the arrow's flow to find the original source document. Now you're asking a totally different question. Does every sale recorded in here have a real-world delivery note to back it up? This is a test for existence.
And this is the beautiful simplicity of it all. It's all about choosing the right starting point to ask the right question. The population of documents you pick your sample from dictates the entire test. If you start from the source documents and go forward, you're testing for completeness. If you start from the accounting records and go backwards, you're testing for existence. It's an incredibly efficient way to audit.
So, when you put it all together, you can see this isn't just about auditors ticking boxes. This detailed, systematic, logical process of designing and performing procedures, it's the absolute bedrock of trust in our financial system. It's what allows all of us, investors, banks, the public, to have confidence in the numbers that companies publish.
And, it all comes back to this fundamental mission statement. The auditor's job is to get sufficient, appropriate evidence. As we've seen today, that evidence doesn't just appear out of nowhere. The bridge between a company's claims and an auditor's trusted opinion is built one procedure at a time.
So I'll leave you with this thought. If every single audit procedure is really just a question that an auditor is asking of a company's financial data, what do you think is the single most important, most powerful question an auditor needs to ask to really get to the truth? Thanks for watching.